Good afternoon. Thanks for being here today. Sorry, one sec. We are here because we understand the importance of money as an enabler to achieving future goals. We want that money to be efficient, whether we're investing as an individual, a family office, an institution. The objectives we have in the future are funded by money today, and we need that money to be run efficiently and professionally. We need it to have the care that it deserves. The care it deserves from being hard-earned previously to be growing with the world and into the future. Now, we don't like to time the market, but the timing of today's summit is pretty much perfect. And we actually choose to do the Endowus Investment Summit after Q1 every year because with almost 100% certainty, consensus view going into the year will be completely different after Q1, and this year is absolutely no exception. This conference is designed to really give you access to the people and the institutions that are actually putting money to work. You get to hear from top global fund managers directly, unintermediated, unadulterated. These are people who dedicate their lives to markets. And we're pleased to be joined by specialists in fixed income, equities, private credit, private equity, hedge funds, and alternatives today. We really want to enable people and empower people to asset allocate like institutions and be the smart money. And I remember when we started Endowus, before starting Endowus, there were a lot of strategies that I heard about and wanted to access. And it has been our job for the last 8 years to provide that access to institutional quality solutions, advice that is conflict-free and evidence-based, liabilities driven to your actual goals, with conflict-free fees. So we're not incentivized to churn our clients. We're not incentivized to push high commission products. We're only incentivized to grow our clients' wealth because we charge the client directly an asset-based fee. And these three components, advice, access, and cost, are what is able to give us endowment investing for all of us. And that's been in our name from the beginning. And zooming in on lower, fairer costs and access, people don't realize that this actually creates a wonderful, virtuous cycle. By not being incentivized to sell high commission products, we as a team are incentivized to seek the best funds after net of fees and continuously do so. And because we're constantly scouring the globe for strategies and trying to bring our clients the best strategies net of fees, it also in turn lower cost. And because we constantly do this and as we scale, access and fees have top fund managers joining Endowus because we create the meritocracy. We create a meritocracy where the best funds delivered at the best level of cost can rise to the top. And we really hope to deliver this to Hong Kong and Singapore, the two markets where we're licensed and operating. And you as an Endowus client, whether you're an individual, and actually in Hong Kong, we've been very focused on licensed professionals. I know many of you today are licensed professionals. Whether you're a family office, and that's investing through Endowus, or our partner, Rhee Private, a single family office, a multifamily office, or an EAM, or an institution managing your endowment, you have access to our client advisors and our digital platform. And behind that, our team of 14 people dedicated to fund due diligence and portfolio construction, curating a fund platform where you can pick and choose your own funds, or where you can buy our pre-built model and pre-optimized model portfolios, or actually ask us to put mandates together for you. And behind that, the world of asset managers, today we work with over 80 and 350 curated strategies on the platform today. Working towards all of your goals, whether they're short-term, medium-term, long-term, cash management, fixed income equities, liquid alternatives, hedge funds, private credit, private equity, direct real estate, and across the different strategies from passive indexing to systematic quant, active, long-short, multi-strat hedge funds, getting you beta to alpha on one platform, delivered conflict-free. And when we give advice, it is risk-based. It is understanding your liabilities and mapping that to the correct portfolios that you should have, whether they're for liquidity, lifestyle in the midterm, longevity for the rest of your life, or you're planning for the next generation or things beyond yourself and your family. We create portfolios with all of these fund managers, give you access, and you can express that on the Endowus platform very simply. If you have satellite views you want to express, you can do that as well. And what you end up with is an overall asset allocation that is tailored and personalized to your goals. We love to go from left to right, not right to left. Because just because the Yale Endowment has a specific allocation doesn't mean that we personally should have a specific allocation. We could have more in private markets because we have a longer duration, or we have upcoming liabilities, and maybe we should have everything in very, very liquid strategies. And this brings us back to our logo, which actually we very luckily have not changed since the beginning of Endowus. Each one of these swooshes, and some people are like, why did you reverse Nike's logo and stuff like that? But we think it looks pretty cool, but it actually has a much deeper meaning. Each one of these swooshes represents a goal in our client's life. 3 swishes, something for shorter term, something for medium term, something for longer term. You can actually have as many goals as you want, as many portfolios running automatically on the Endowus platform. But what's important is that they are separate and they each have, scientifically, the highest probability of achieving your goal. And then, as the investment office, we create portfolios that then map efficiently across the efficient frontier to your specific goals and needs, depending on their duration, liquidity, and the volatility you can tolerate to achieve that goal. And really, we want to stand on the shoulders of giants. A lot of our partners are here today because they manage hundreds of billions, not trillions of dollars at scale. And all of us deserve, and actually with the power of technology, can stand on the shoulders of these giants. Finally, in Hong Kong, it often seems like people are either really, really safe, they have way too much cash, or they're punting on stuff that is really, really dangerous with very, very random expected returns. Now, in the short term, targeting a lower to a higher expected return doesn't really make a huge difference. But if you have goals that are longer term, it is so incredibly important that a longer time horizon, less liquidity need, higher tolerance for volatility, lets you move up. Because a 6% annualized return and a 10% annualized return is the difference of 17 times to 5.7 times your money. So you really cannot be lazy. Plan today, allocate risk properly today, because in the long run, and 30 years is not a long time when it comes to investing, in the long run, it pays off massively. Finally, I'll end with a quote from Charlie Munger. He said, "Show me the incentives, and I'll show you the outcome." This is how businesses work. This is how systems work. And in Endowus, we want conflict-free, systematic alignment of incentives to reach your wealth goals, because that is what is in our control when we interact with markets. And we have to control what we can, because uncertainty is the only certainty, and that's always been the case. I'm sure that uncertainty will be a word that is overused today, but uncertainty is the only certainty. And now I'll hand it to my co-founder, Sam, to take us through some macro.
Thank you, Greg. Greg gets to do the fun stuff, and I have to do the difficult stuff. But before I do go on to my presentation, we have Slido. So Slido, if you can scan the QR codes that are going to pop up on either side. If you can scan it, and then we're going to do a survey. 2 questions that we're going to show on it. One is asking you, what do you think is going to be the best performing asset class this year? And then the second question is, what do you think is going to be the best performing asset class until 2030? So by the end of this decade, so a 5-year period from now on. And we're going to share the results. I mean, we'd love to hear from everybody where the consensus is, because it's always great to get the temperature of the crowd. I came up with this bunch of slides because Greg said it would be great for Sam to talk about macro and markets. I thought it was a bad idea, but I've been forced to do this. And the outcome is a Latin phrase just to make me look more sophisticated, but also because I wanted to, in these volatile times, focus on some deep philosophical questions. But then this happened overnight. And so everything went out the window. This morning I had to redo all my slides. And so we're going to start with this slide, which is what the market has done, right? And yesterday that tick up was not there, and it was looking pretty grim. So I was worried that I was going to present to a bunch of very depressed personal and professional investors, but luckily we're actually not too bad. But year to date, we are negative, and there's a lot of fear, uncertainty in the market. But let's pull this back a little bit. A 1-year chart doesn't look so bad. It's actually positive, right? This is the S&P 500. And then we pull it back even further, and we realize that actually perspective is so important when you're investing. And it's phenomenal. Most people don't realize that we've been in one of the most volatile periods in history when it comes to equity markets. We've had 4 corrections of more than 20%, which is the definition of a bear market. In 2018, we had the taper tantrums. 2020, we had the COVID shock. 2022 was a rapid rise in Fed interest rates and inflation. And again, we had another shock. We can divide the 2 events that happened in 2018 and 2022 as a normal economic cyclical event, where it played out over many months in 2018, over a year in 2022. But the 2020 COVID shock was an external shock. And by all definitions, today is an external shock too. So you can see how the market responds to the different cyclical shocks and also the external shocks. And the reason I wanted to highlight these is the fact that never in the history have there been 20% corrections in 7 years. It's very unusual to see a 20% correction. But the second thing is that when we look at the COVID crisis, what happened back then? Massive disruptions to global supply chains. There was a war that disrupted it even further. What were the consequences of that? Were inflation, right? Price movements and a reaction from the Fed. So you can actually say that, was there a causality between the external shock and the cyclical macro events that transpired over the next 2 years? And that's a question we need to ask ourselves now, because it is an external shock, and we may see a quick rebound. But we have to understand what is going to transpire over the next, not month or weeks, but what's going to happen over the next 6, 12, 18, 24 months in terms of the global supply chain, trade, economic growth, and inflation and prices. And that's why I show this chart. In 30 years, I've been working for 30 years, by the way, in finance. More than half of that was in an asset management role as a professional investor. I've never seen anybody able to predict the market consistently and generate alpha every single year. So I'm not going to predict what's going to happen to the markets. I'm not going to predict or second guess what Trump is going to do, because I think it's futile. What I am going to share with you today is some observations that I have seen that has transpired in the last few weeks and year to date. And I hope that it will be helpful. And then I'll share some more stuff, interesting stuff later on. But one thing that we realize is that the US exceptionalism, and whenever somebody uses a term so repeatedly that it becomes part of common vernacular, like US exceptionalism being used by media and everybody, then you know it might be towards the end of its life cycle. And so what we've seen is actually a convergence from just US outperforming every market around the world to other markets year to date, even before Trump and tariff, right? It's not just Trump and tariff. It happened before that. It was Europe outperforming. It was China starting to outperform. So is it Trump and tariffs, or is it a new regime that we're entering? And that's something to think about. In terms of asset class as well, equities did tremendously well. But fixed income started outperforming before the tariffs. And commodities actually have been hit rapidly after outperforming for a certain period. So the point about both of these things is that diversification is actually alive and well. That the 60-40 balanced portfolio this year has done relatively well. And so we have to think about the learnings of history, such as the benefits of diversification, the free lunch in finance, the only free lunch in finance, in periods of stability and volatility. And this is a wonderfully colorful chart. It looks really great. What does it show? It just means different markets outperform every year. It's very difficult to predict those markets. And you can do that with sectors. Different sectors globally outperform every year. And same thing in fixed income. Different sectors outperform. The bottom line to all of these charts is that, again, it's very difficult to predict. And it is not the job of a financial advisor to predict the future, but to journey with you and understand your needs and your risk appetite so that we can help you get to a better understanding of markets, better understanding of risk, take the appropriate amount of risk, and be compensated for that risk. So where are we in the cycle? And I'm going to show the next chart, but similarly, like equities, if you pull back a little bit further, the left side shows the last 5 years of where the interest rates have moved. Yes, and it's a big move from 0 to 5%. But if you just space that out a little bit more into not the 100 years, but since the 1960s, and you can see that actually interest rates being at 0 is actually the anomaly. And 4% is actually just below the norm, historical. So I think you need to understand that having the proper perspective and having that long-term perspective allows you to see things in a very different way. And my final point again is why Endowus doesn't make predictions is because everybody is always wrong. And you know, I've been a professional investor all my life, and it's very difficult to predict even what the Fed is going to do. This was at the end of last year. Not what people said they were going to do. This is actually people putting their money where their mouth is. There's option-implied probability of Fed fund rates. And we had a period at the end of 2024 where they said they were going to see 8 cuts within the next 12 months. What has transpired is something completely different, and the market keeps changing its view. So trying to chase the market, trying to chase individual views or strategists or economists trying to predict the future is something that is a strategy that is doomed for failure. So what can you do? Every day we're making decisions about our money, and we are here at Endowus to help you make better decisions so that you can invest better to live better. You can spend, save, speculate, but there is only one way you can consistently, over time, compound your returns so that you can beat inflation, that you can beat uncertainty, you can beat volatility. So investing is the only way. And if you look at the historical evidence, and we're an evidence-based investor, this is the long-term chart since 1920. S&P 500 actually has been around for 100 years now, almost. And this is where I get deeply philosophical. These are the slides I prepared before what happened yesterday. You've never seen these charts in a financial conference. I've never shared it at a financial conference either. But I came up with the idea, so I thought I'd share it. The universe has never stopped expanding. Did you know that? It's actually expanding at an accelerated rate. What's interesting is that when Big Bang, or whatever you want to believe in, happened, the first initial surge, the swoosh of expansion that happened it's a scientific term. It's called inflation, right? Where finance and monetary term has hijacked the use, but it's a scientific term. But it's not just the universe, guys. This is the world's population. It's never stopped growing. And if you think of human beings as a factor of production, it's one of the reasons why global economic growth has never stopped growing either. The quantum of money and liquidity has never stopped growing. And these are the natural human trends that anchors this move. And so you have to reassess, especially in times of volatility, what you believe in, right? Religion is one of those things you can reassess at times when markets are crashing. We become very existential. But we have to understand, do we believe in the power of markets long term? And that's going to be anchors in deciding how you invest over the long term. And again, Greg presented this, but we go back to this again and again and again. Because investing is not about outperforming or beating the market or generating 25% returns. It's not about getting the next stock right. It's about understanding who you are, what you need, what your long-term goals are for investing, matching the different goals you have, individual and personal and family, to the risk you're taking. Because without risk, you'll not generate returns. But a lot of times, you take unnecessary risk and you never compensated for that risk. But you take the appropriate risk, and for each risk bucket, you're compensated and you generate the returns you need with the best expression of that risk bucket and at the lowest cost. And you're able to build strategic portfolios in a liability-driven way, in an institutional framework that will allow you a better probability of success. And that's what Endowus is. With that, I'm going to share the Slido results. I thought it'd be interesting. If you haven't done it, too bad. Sorry. Okay, first one, year to date, 12 months. Oh, wow, gold. Very conservative bunch. But the next one is equities, 24. If you add with private credit, that's 29%. And then private credit, fixed income, okay, 22. Pretty balanced. And 6% cash, ultra conservative. And 7% Bitcoin. Next one. By the end of the decade, wow. So you guys are already believers in what I presented. Equities, long-term, private equity, but surprisingly, Bitcoin and gold. We'll talk about these topics in the sessions that are to come. Thank you, everybody. Enjoy.